composability is that could any users be able to use all the DeFi products in different chains easily? Basically, in my words. And the question Vitalik says is yes, but Ether is naturally supported. But all the contract-based tokens or ERC20 need modifications. And here is his words. He said the ERC20 cylinder would have you need to modify, be able to do something, be able to transfer from one shard to another shard. And so there are a lot of open questions here. Will this modification significantly increase, for example, the token creator, for example, the ERC20 creators' effort to maintain all these tokens? Because it looks like there are multiple ERC20 contracts represent for the same asset in different shards. And maintain all these contracts will be much more difficult than right now. And second, would this modification introduce additional, for example, security efforts, so that people need to put more efforts in security, in audit, in testing to make sure those, for example, contract-based tokens are working properly. And I think this make right now the security situation become even worse. So after summarizing what we have observed in right now the DeFi platform, we believe that in the future, when the DeFi market grows rapidly, we need a platform with first better security, better user experience, and better scalability. And there's a bonus that it can also help developer to provide a better developer experience without have too much concerning of standard security issues, user experience issues, or scalability issues. So our thoughts to provide a better platform is to provide a solution that use first multi-native token plus DEX plus sharding. So multi-native token, we allow the users not only to create, for example, to use the default native token like Ether or QKC on us, but every user is able to create their first-class citizen native token and be able to claim their ownership, be able to mint, whether they use a single owner or can be a DAO, and further using DEX. Together with this native token, we allow users to use this native token as transaction fee, while we still maintain a lot of problems of, for example, different pricing of native tokens. And lastly, with sharding, we hope that we can easily scale the network and not only the default native token, but all the native token can naturally enjoy the scalability that brings by the sharding technology, while with almost nothing in terms of actual development efforts. So first, let me go to some details how we are able to solve these existing problems. So first, existing problem in terms of security is that we call it infinite approval. What does that mean? So because of the limitation of the current platform, for any ERC token, the users must, before participating in any DeFi application, a user must first approve the DeFi application, the smart contract, to spend the user's assets on behalf of the user. So for example, suppose I want to put $10 in Compound and say, hey, I want to lend to somebody else. Then before I move this $10 to Compound, first I say, hey, I will approve Compound contract to move $10, spend my $10 to anyone. And then I participate in the, for example, lend, then the contract will move my $10 to the contract and mark it internally, say, hey, there's a $10 that I have. I can use this $10 to lend to somebody else to earn the interest. And so the approve means that I have to trust the contract that will not do bad thing, that will not steal my assets. And in addition, it has an allowance parameter. So for example, just now in the previous example, I used $10, but in reality, to avoid multiple approvals, because each time users want to do with just for example $10, the next time I need to do another approve for example $100 if you want to lend. So basically, all the DApps that I use, Uniswap, Compound, they will ask users to just submit a proof with infinite allowance. That means the DApp is able to spend all my assets using under the name, for example, USDC, even just in my account, not in the contract's account. So here is an example. When I submit, for example, before I participate in the Compound, so it will submit a proof with two parameters. So first parameter, which start with 3988, blah, blah, blah. This is basically the contract of the Compound saying that, hey, I approve this contract to spend for me. And the next one is FFFF, infinite F. That is basically infinite. Basically, how much this contract can spend on behalf of me, that is infinite. And as a result, this hacked contract can transfer not only my assets that is stored in the contract, but also all the corresponding assets in my account. So for example, I have 1 million USDC, proof of contract, and say I want to participate. But someday the contract is hacked, and the hacker can move all my $1 million, even it is just in my account. So the recent incident of Banker is that they found an issue that the hacker is able to move on behalf using the contract and then be able to move users' assets. And in addition, this problem become, I would say, much harder to know unless you are being really attacked, because a few DApp provides a called unapproved operation that say, hey, I don't want to trust anyone that is be able to spend my assets on me, but actually a very few DApp provides that. And so another question is called a non-standard ERC token. So we saw that a lot of non-standard ERC token introduce extra features and create further security concerns. For example, ERC 777, we have the called emergency issue, which caused this DeFi called landf.me is attack, because although they use the heavily audited compound code. And even ERC20 tokens in themselves have bugs that may, for example, the main chain token has this bug, so they can issue infinitely. So with the multi-native token we designed, we allow everybody to issue the first class tokens and use it to transfer between different contracts. So there's no approved operation. A user just send its native token to participate in the app, and it will never risk the asset in the user account. And all the native tokens, they have standard behavior. So we don't need to worry about the further security implications of actual features and ERC20 token that brings, and eliminate a lot of re-entrancy issue. Another thing that user experience is that we believe the future DeFi platform, it can allow user to use any native token as transaction fee and to eliminate for example, other token, for example, Ether, or all this education cost. But the concern is that we heard the default native tokens utility value. And here our answer is no. How we are able to do that? It basically, when we perform a transaction using other native token, the system will automatically swap it using a system-wide DEX. It can be implemented as a Uniswap, or it can be implemented in other kind of simplified DEX. And user, from user perspective, you just pay any native token. But when the miner process this transaction, it will receive default gas token after swap. And this also helps the miners to identify those transactions with high values and put higher priority pack into transaction into the network. And lastly, better scalability. So native tokens are stored in the user's account. And so since as long as we are able to move default native token like Ether between shards, which we totally give a comprehensive discussion on how to achieve that, then we are also able to move native token between different shards. And that means all these native token can immediately enjoy the scalability that enabled for by more shards. And from DApp developers, in order to support this native token, they would just deploy the contracts in different shards with a very minimum code chains. And so as I just mentioned, this all native token can enjoy increased scalability with more shards. Just naturally, there's no extra work to do. Just issue a native token, mint it, and scalability is done. Gradability is done. And we are also be able to move these tokens, so we are able to enable cross-shard composability. People can enjoy all the DeFi products in different shard chain very easily. And so we totally give a list of examples how to do this. So I won't go through details, and here is the link. And lastly, the bonus. Basically, right now we have a native token ERC and native token Ether and ERC20 tokens. And the developers need to basically put extra effort in order to support both sets of codes. So right-hand side is a source code of Compound. Actually, you can see that in order to support ERC20 and Ether, it has to provide two separate codes in order to make sure the system works correctly. And also, a lot of old DeFi, like MakerDAO, it start with Ether first. And then when it migrate to using other ERC20 tokens, they have to do a lot of effort in terms of migration and create further concerns into security or arbitrage space, a lot of things. So you can read this story about how they replace their DAI with legacy DAI with that's called Psi. So as a summary, we are projecting that the needs of the next generation DeFi platform with better security, better experience, better scalability, and a bonus in terms of better developer experience. And so our conclusion is that multi-native token with DEX plus sharding could be a really good solution. It provides better security by using standardized native token, which avoids a lot of security pitfalls, as I just mentioned, infinite approval, non-standard ERC20, a re-entrancy issue, all kind of this. From user experience-wise, with system-wise default DEX, it provides a way to exchange any default token, native token to default gas token. So the gas token still has its utility value as gas, so all the transactions still use it, but all the users of native token holders, they do not need to hold the gas token, and they can use any native token, USDT, USDC, as transaction fee. Just like we use it to pay, for example, Visa or Master. And lastly, next is scalability. Sharding enables scalability for native tokens. So for any native token, scalability just they can enjoy the benefit of scalability being by those sharding and be able to moving all the native tokens from different shards to another shard to another, from one shard to another shard. Then this DeFi composability is also enabled, so the people can use the token to participate all the DeFi products in different shard chains in the network. And lastly, well, with this native token, there's a very minimum code change is required for the existing code so that it can harvest all the benefits I just mentioned in terms of security, experience, and scalability. And so this is the basically the last slides. which actually have been working towards this direction since we start. And we are putting a lot of effort to make all those that is also be able to happen. So from security, we are now able to have all our users to issue and mint those native token. And from the user experience wise, we already program exchange in the system-wise exchange to provide this swap feature, so the user can use any native token to pay as gas token, which we will enable it in our mainnet in the next half a year. And from scalability-wise, we have finished this when the project was started with sharding, and we are also natively support moving all kinds of native token between shards, and so all kinds of the decomposability that listed by Ruitao, all the scenarios are now enabled. And lastly, the platform code is enabled to be able to handle this multi-native token. We already support that, and we are also providing library code to try to simplify all the development process with better test case, with better document, and with also better, for example, monitoring tools. So our next step is to host a campaign on our testnet this month, and this campaign will last maybe for 1 or 2 months, and so that people can really experience all kinds of this, I would say, benefits, security, user experience, scalability, through our first testnet, and later mainnet in the next half of the year, and people can earn the reward in terms of QKC by issuing, minting, and playing, for example, performing transaction, or deploy the users of smart contract in testnet and to play with these native tokens. So that's all for my today's talk. Thank you very much for attending my presentation. So if you have any questions, feel free to reach out quackchain.io and visit our forum community at quackchain.io, and we will be happy to answer any question you have. And also, if you want to participate in this event, we are really happy and will welcome everybody to participate. Thank you.
Welcome to join this talk. Very happy to be here actually at the Unitize 2020 to talk cross-chain DeFi in action, right? And also introduce you to the Acala network, that is the DeFi chain for Polkadot. And a bit of intro for myself. My name is Bette Chen. I'm the co-founder of 2 projects, Acala Network and also Lamina. Both are projects building within the Polkadot ecosystem. So Polkadot is this multi-chain universe. So in this talk, I'll give a bit of the context of Polkadot Network, what it looks like, and what it meant for DeFi and probably debt builders in general to build on Polkadot. And then I will go into a bit of detail for DeFi, that is Acala, as the DeFi shard or the DeFi chain that provides financial primitives such as stablecoin, decentralized exchange, liquid staking, as well as a bunch of financial optimizations that will be very attractive to a lot of the financial innovations and debt builders. And lastly, I will actually very lightly touch on Akala's DAO 3.0. How we use on-chain governance and also our decentralized sovereign wealth fund to achieve digital sovereignty. And if time allows, I will briefly provide a live demo to everyone here. So before I actually get into Akala specifically, I actually want to provide a bit of context for cross-chain, and that is to speak about Polkadot being the heterogeneous multi-sharded protocol. And Polkadot is really like layer 0, if you like, as it actually provides all the primitives, that is trust, security, interchain communication for layer 1 blockchains, like Akala, to both specialized or specific blockchains or shards that are interoperable in a meaningful and secure way with one another. And if you look at like Ethereum 2.0, that is a multi-shard with a single consensus, but each shard is exactly the same, and that is homogeneous, right? And on the other side of the spectrum, and like Cosmos, on the other hand, is each hub is completely independent. And you can have completely different consensus, and also security is provided by its own hub. And Polkadot really occupies a unique design space in the middle. And that is like each shard or each chain would be a specialist chain, and they can be different, hence heterogeneous. And each special chain could be optimized for DeFi use cases, gaming, IoT, or anything that you can think about. But they share security provided by Polkadot. And another point I want to make here is also the upgradability, which many people probably didn't realize is you probably realize the only constant we have is change, right? And historically in blockchain evolution, we've been lacking of this concept of agency. And that is a change agent that a group of people can express their will and also execute actions to achieve their purposes, right? So Polkadot, through the substrate framework, allows forkless upgradability with on-chain governance. And I'll show a little bit of how Akala actually implements this. And this is what it looks like if you actually build on Polkadot. So Akala is the DeFi shard or the DeFi parachain, and that is just the name for heterogeneous shard or heterogeneous chain, and amongst many others, right? And Polkadot's relay chain is the proof of stake network that will provide security and also interoperability for message passing between different type of chains. As I mentioned, parachain is just a name for heterogeneous chains connected to Polkadot. And Akala network is really the specialist DeFi parachain, DeFi shard for Polkadot. And Akala is you can think about it as the special economic zone on Polkadot network. It provides financial optimizations and financial primitives. And so we could have like optimizations like fee schedules are customizable. So when you say transfer some DAI or some US dollars, you could just pay US dollars as fees rather than the network token. And we can also optimize for Oracle operations. For example, we can employ quality of service so that Oracle operations are prioritized as important services on the chain for DeFi applications. And Akala also provides a bunch of DeFi primitives. So there's a cross-chain capable stablecoin that can use cross-chain assets such as Bitcoin and other assets as collateral for credit line facility. And also the dollars or the stablecoin that's generated is also cross-chain capable in that regard. And the second thing we offer is as primitive is a decentralized exchange that obviously will boost liquidity for the chain. But I'll talk a little bit more later on what else does it offer, because it's quite a unique way for us to bootstrap the network using a DEX. And then the third thing that we offer as a primitive is liquid staking. Yeah. So which will release much of the liquidity on the POS network specifically for DeFi. Yeah, which would otherwise be locked in for proof of stake. So I'll talk a little bit more on that a bit later as well. So really, Akala is the open platform for other DEP to build on top of. And there's a spectrum of options depending on sophistication and also levels of customization required for your DEP. So, and the different ways that we can build together. Within Polkadot and also on top of Akala. So I'll give also a bit of context here is on the Substrate framework for those who are not familiar with it. So Substrate is really just a blockchain framework that abstracts away much of the complexity of building a blockchain, but at the same time allows you to have various level of customization. So for application or protocol developers, builders like ourselves, we mostly focus on customizing chain logic for our purposes. For example, in our case, we focus on optimizing or building more functionalities for financial implementations. But we're not worried too much about consensus or the P2P communication or story per se. But you could, customize all of those if you like. And this really allows DEP development on top of Akala have many different options to build on Akala. So for proof of concept or a quick deployment, you can deploy your Solidity smart contract directly on Akala and via EVM capability on Akala or Substrate chains, right? So, but at the same time, you can leverage the existing financial primitives that's been provided, like stablecoin, like DEX, etc. Otherwise, you can also use a more efficient Rust-based Inc. Smart contract facility provided by Parity to build and deploy on Akala as well. So either way, it's a smart contract. And then the second way that you can build on top of Akala is you can deploy a more integrated chain logic. That's what we call runtime modules. So you can actually develop a more integrated solution on Akala network. And that version is it does require permission and also requires security audit because it does change the chain logic, right? But a good example is we're currently working with quite a popular Bitcoin bridge team, and they would build what we call a runtime module, right? So really it's customizing and integrating with our existing facilities. And for example, when you do a cross-chain Bitcoin transfer to Akala, you no longer need to pay fees in our network token. You can just pay, the version of Bitcoin as transaction fees. And that is the type of customization that can be allowed with this type of integration. Of course, the third way is you can build your own chain, but of course you will need to provide your own liveness as well as chain maintenance, etc. But you can also integrate and use Akala's facility using the cross-chain facility provided by Polkadot as well. So those are the three ways you can build smart contract or more integrated runtime module, or you just build a chain and connect with Akala. So let's look a little bit more closer at Akala's protocol. So we have three core protocols offered as financial primitives, open for anyone to use directly or build on top of. And the first one is the multi-collateralized stablecoin, and the second is DEX, the third is liquid staking. So I'll go through each one of them. So for stablecoins, we offer cross-chain valuable and also high quality assets and autonomous credit facility, right? So and this is maker inspired. So the collateralization mechanism is quite similar, but we've improved quite a bit on optimization, liquidation, and also liquidity provisioning for the stablecoin facility. So for example, we can use Bitcoin as a cross-chain asset and provide programmability and also credit facility for these otherwise isolated asset class more use cases. And at the same time, there's also other financial innovations can be built on top of this. There's also this decentralized exchange that's also very interesting to mention here. It is a very simple, like constant product automatic market making system that many DeFi people in the DeFi will be quite familiar with. But in addition to use it for bootstrapping liquidity on a Kala network, it also supplements our stablecoin liquidation mechanism. Whereas like auctions might be a good mechanism for optimizing pricing, but it's not so good for efficiency. So when we had the Black Thursday happened in Ethereum's DeFi arena, we had like huge inefficiency in auctions, right? So in here, instead of only using auctions for liquidating collaterals in case of liquidation, we can subsidize it for selling collaterals on the DEX first if slippage is good. Before auctioning them off. So at the same time, liquidity providers will have multiple ways to generate income. So apart from getting exchange fees as a return, they also get additional profit sharing from stability fees of the stablecoin. There will be more ways to farm here. And another thing is the third protocol that we offer is tokenized staking liquidity, or liquid staking, if you like. So on a proof of stake network, staked assets like DOTs, there's a competition between staking and DeFi. So there's a competition from getting yield from staking versus getting return from DeFi activities. So we've created this trustless and also super easy way for you to stake your DOT through the HOMA protocol. It's simply a swap. You're swapping your DOT with the LDOT token, and you are staking. This LDOT is yield bearing. You'll be earning staking yield by just sitting on it. But of course, you can also transfer it. You can use it to borrow more liquidity or do more DeFi stuff, right? So liquid staking is really the stereo for DeFi on a POS network. So to sum up though, Akala is the cross-chain DeFi shard or the cross-chain special economic zone for Polkadot multi-chain universe, and we have the highest level of security provided by Polkadot, and we have cross-chain assets in and out of the network at the same time, Bitcoin and others alike. And we've also made available a number of financial primitives for others to use and also build upon. And that is like stablecoin, liquid staking, and also decentralized exchange. In addition, Akala is a DAO 3.0, so is a decentralized autonomous organization, version 3.0. The reason being, so it actually has a change agency with on-chain governance. It has a voting system, allows token holders collectively to make decisions, and also in a very smart way. So there's elected councillors to delegate to make delegate decision making. It also has democracy modules for referendums and also collective decision making. And the second thing it also offers is an execution apparatus. And this actually ensures decisions are binding. So for example, if we want to raise interest rate from 5% to 20%, upon making that collective decision by voting on chain, it can be executed on chain, and the decision makers can choose execution strategy. For example, it can say increase from 5% to 20% over 3 months period, and gradually increase over every block to soften the block, for example. So that can also will be implemented on Akala network. as well. And the third thing for DAO 3.0 is the decentralized sovereign wealth fund. I won't have much time to go into details, but at a high level, it's a trustless fund that will reinvest the network surplus generated from the revenues of the network. For example, the stability fees, the transaction fees, etc., and all the surpluses will go into this fund and will be invest in foreign crypto assets. And these assets will need to meet certain criteria. For example, they will need to have value, they need to have use, and also utility. So for example, DOT will be a good first candidate for that. So the fund will probably hold DOT, and it can stake DOT to earn a return, to earn a yield. And also later, it can use the DOT to purchase or rent security for the chain. And once it can actually do that autonomously, it will become self-sustaining and also economically sovereign. And it will have enough money for its security, so it will be independent chain, but at the same time, will continue to generate wealth for continuous development and improvement or running or maintaining the chain. So of course, the most important thing is the wealth fund itself is also owned by the network. So collectively owned and governed by the token holders via governance. And I think that is a truly digital jurisdiction in the making. Yeah. And this is a chart that what it looks like when you zoom out a little bit with Polkadot relay chains and also other parachains like IoT chains, gaming chains, social network chains, etc. And Akala occupies the space of DeFi, and various applications will build on top of. So apart from the Bitcoin bridges that I mentioned, there's also other types of stablecoin. It's going to land on Akala. There's room for many different types of stablecoin and other type of assets to land on Akala and do many interesting financial innovations there. So this is where we're at. So we've launched multiple testnets so far, and there are already 3 testnets candidates been launched, and we've launched also a whole suite of financial products with what I've mentioned, right? So the DEX is available, the stablecoin is available, as well as the liquid staking. And what we've achieved so far is at the peak of it, we've got 1,300 plus nodes running for the test network, 4,000 plus active accounts been generated, 14,000 plus like meaningful transactions. That's actually doing the DeFi or trading activities that we've seen. And later I'll provide links for people to actually be able to try all of this. And yeah, we are also fortunate enough to be backed by some of the top VCs in the field, like Chain, like Hashkey, KR1, and many others who actually help us to build many of this stuff together. And also our ecosystem projects, teams who will build with Akala one way or another, and as I mentioned, either deploy on Akala or actually connect to Akala in one way or another. And yeah, and then we started to actually grow outside of Polkadot as well, because there's also Ethereum and also other communities who's looking to connect, because the future is probably more multi-chain than chain maximization. Yeah, and then lastly, there's also a bunch of liveness providers, or more traditionally they're called validators, who joined us to provide liveness to the network. And I think this is a point where I would like to run a bit of live demo. I think it's quite a brave act if you can do live demo, but I think if a picture worth 1,000 words, a live demo probably worth the whole presentation. So let's see. Here you actually land on the financial suite that I was talking about, a service center. And in here, you are able to browse into the Akala network. and you will see various tokens available on the testnet. So this DOT, there's the ACA is the network token, the AUSD is the Akala dollar that's been generated as the collateral stablecoin, and then there's also cross-chain assets like Bitcoin as an example, and also LDOT is the liquid staking token, which I will explain a bit later as well. So let's just go through an example. So this is the self-service loan. It's a credit facility that you can use cross-chain asset to generate US dollars. So let's say I have a bit of Bitcoin that I've bridged in from the Bitcoin network, and then I'll use the Bitcoin to generate some US dollars. So in here, as you can see, with the balance I have, so I'll just like use one Bitcoin to borrow, and I could borrow up to $7,600. And if I do that, I'm definitely allowed, but I'm close to liquidation, right? So I'll be a bit conservative, so I'll just go for $7,000. Even for that, I'm given a warning, because if the Bitcoin, if Bitcoin actually drops to 7,700, then I'll get liquidated. So let's be more conservative. So that's how much I will borrow. Like with one Bitcoin, I borrow $6,500. And yeah, with like, so at the moment, you know, the interest rates is arbitrary. So before we go live, we'll have a bit of a fine tune of the interest rates and etc. But also bear in mind, all of this can be upgraded and changed on chain with governance. So this is popping up as the Pogo.js, is the wallet that provided. Oh. That is always the thrill of doing a live demo. Something's not working. Yeah, so, oh, okay. So that is a transaction done, and you'll notice it actually happened quite quickly because the average block time is between 2 to 4 seconds and without optimization, right? So this is how fast it can get on here. And here's the loan that I've created for myself, $65,000, and it's already having some interest being generated. And in here, you know, I've also self-managed. I can pay back the loan, or I can generate a bit more US dollars, and I can deposit more Bitcoin or withdraw as I wish. And at the same time, we have integrated with explorers like Subscan, and you can actually browse all the chain activities on here quite easily. And the next thing I want to show you is like quite quickly, and I may not go through the entire demo, is here is a Uniswap like exchange that's made available here. So you can actually say, I've got some US dollar that I just generated from the Bitcoin, and then now I want to, maybe I want to double down, like on Bitcoin, I just leverage trade on Bitcoin, so I can just do that, right? So and then you just exchange it. So this is, yeah, not too fast about it. But what is interesting is this deposit and earn. So that is the place where liquidity providers can provide liquidity, can deposit liquidity to the swap pool. And this liquidity, for one, it will just use for the DEX for exchange, but secondly, it will use for liquidation for the stablecoin. So as I mentioned before, when liquidation happen, the liquidity, it will actually liquidate the collaterals on here first, given the right slippage. So, and liquidity provider will gain extra reward. So the total return will be actually quite lucrative, given the additional stability fee profit sharing. And then lastly, I'll just like quickly show the liquid staking portion of it. Normally when you stake, you have to go through a number of steps to put your dots, bond your dots, and also go through a process to stake and choose the validator. And then here we have a meta staking protocol where you just simply like swap your dot with the liquid or L dot token, which is a fungible ERC20 like token that you can hold in your wallet, right? And then once you stake this your dot, you can just leave it, and then your L dot will continue to be in your wallet, and it will generate dot returns, and you can actually see all the details in here. And what's also interesting is, apart from you can transfer the dots and etc., you can actually redeem your dot immediately. So normally when you stake, there's an unbounding period. You have to wait for a certain period of time before you can unstake. But with the design of our pool or our liquid staking protocol, you can actually have that liquidity immediately if you like. But of course, you will need to pay a bit of fee to make up the liquidity that you have. And then with the L dot that you have, you probably already seen it when I click through the credit line here, is that you can actually use your L dot to generate credit facility, right? You can generate US dollars using your L dot. So think about that, right? So your L dot is yield earning, sitting there yield earning, while you're actually loaning out a bit of liquidity for yourself to use or trade or do anything else. So that is the beauty of crypto, in a sense that your money can be in two places at one time. And then lastly, this is still work in progress. So on the interface, on the UX side of it. So here is what governance looks like. So on Akala, when I say voting system, it's not just a simple vote per se, because we have to consider different functionalities of the vote and also different ways of voting. So for example, on Akala, the general council will look after the entire chain. So for any upgrades, any runtime upgrades, change any of the chain logic, etc. And then the Hong Kong council, which will also be elected council seats, it will look after, say, the stablecoin parameters. So, for example, if I want to change interest rates or change liquidation rates, for example, these guys will be dedicated decision makers, if you like, to make those decisions. And then technical councils, if there's a bug or anything, it requires urgent change, and they can raise it and go through the process. And then for us, it is a practical, progressive decentralization. So which means at the very beginning, it will be relatively centralized. So a lot of these councils, decisions are made by the councils. And then the next step for us is to open this up to referendum. So to all token holders or stakeholders, where they are able to propose any proposals and also participate in referendums, as well as electing council members. And this is an example of a motion or the proposal that people made, and you can actually see this is a changing liquidity incentive rate for DEX, and then how much it's changing too. And as soon as this motion is passed, the threshold required, then this will be executed on chain. And of course, execution strategy is also customizable, and people can require to say it's going to execute immediately, or I want it to change over time, for example. So so all in all, that is Akala network that I want to show you today, and that is only at the beginning of cross-chain DeFi in action. I think this is only the beginning, because as we progress through, you can see there will be end users using these protocols, and then also empowering a lot of currently isolated asset classes like Bitcoin to have programmability to be used in DeFi, and also many other use cases. And the next step is for more dev developers to come on board, which we are talking to quite a few of them, to actually build and innovate for a multi-chain future. So that is my talk today. So so if there's any questions or any inquiries, we'll put some link through at the end of the talk, and don't hesitate to contact us and ask questions. And also, most importantly, try out the dApp, try out the applications, and tell us what you think. Thank you.
What? How?
Why?
They? No, it's B.
B. 货币. Always open. Trade where you want to, when you want to. 货币. Your trustworthy crypto exchange.
I'm Richard Ma, CEO of QuantStamp, and today I'm going to talk about how, despite all the hacks, the future is still DeFi. So DeFi has been growing really rapidly recently, and I think we've really seen product market fit with DeFi. It's possibly one of the first category of applications that I think has achieved product market fit. And the vision of DeFi is to replicate many of the financial products and services that are in traditional finance, but now on the blockchain and without a central authority, so people can basically do many of these functions in a permissionless way. Right now, the value that's locked in DeFi has recently surpassed $1.6 billion. And actually today, it's actually surpassed $2 billion. And this has really, built as a trend over the whole of 2019. And now with the launch of Compound, it's really increased. So why does this matter? Well, it means that people are actively lending, borrowing, using DEXs and on-chain derivatives. And more often, we've seen this trend accelerate. So in December of 2019, there was less than 700 million that was locked in DeFi. So it's around tripled in the last 6 months. And it also indicates a desire for an alternative financial system. Because as we see with COVID, central banks are printing more and more money, and the interest rates that are available in the traditional financial system are quite low. So, people are looking for a better option. One of the benefits of DeFi is composability. So what that means is like, the analogy is like money Legos. So you can produce components that, live on the blockchain, and other companies can then build on top of those components and make more interesting applications. So by linking up these different applications, you can get more functionality without having to repeat all the work that someone else is doing to build up these building blocks for you. And over time, this has a compounding network effect, where as more and more services in the ecosystem are available, it becomes easier to build additional services on top of it. And one example of that is called R-trees. So R-trees, they allow people to donate interest that is parked into an app called Compound and use that to plant trees. So, R-trees, they have a nonprofit that is planting trees. And if you deposit your DAI, your savings, into their contract, your principal is actually preserved. So you're not really losing any money on your principal, but the extra interest is going to their fund to plant trees. And they're using this composability concept, because our trees is based on top of our DAI, which allows you to separate the principal and the interest from your interest payment. And also Compound, which is an app that allows you to get interest on your money on the blockchain. So, and Compound is growing quite rapidly. In June of this year, they released a Comp token, which is a governance token that's being farmed out, being provided to people that use the Compound system. And since they had this distribution, Compound moved from the second most used project in DeFi to the first. So they eclipsed MakerDAO in that process. And if you look at the chart on the right, I think it's definitely a testament to the incentives of doing yield farming, because it can increase the interest rates. But we also see more and more teams doing this. This is kind of the yield farming trend. It's also, in a short amount of time, the Comp token has become the highest market cap token of any DeFi token. Over 700 million has flowed into it to take advantage of these yields, because you get the existing yields that you can't really get in traditional finance, where the yields are all below 1%, but you also get an additional yield from the distribution of the Comp. And so this is kind of a double-edged sword. It provides new opportunities, but also new risks. So I'll talk about the opportunities first. One of the opportunities is that Compound is basically like a decentralized money market. So people can supply, other people can borrow using their collateral, and pay interest and get interest, and it's all being facilitated by the smart contracts. And every day, if you're a borrower or you're a supplier, you get paid additional Comp. And this has, at times made the interest rates as high as 50 to 100% a year. It fluctuates based on the overall usage. The major risk is that, one is that most people don't really understand the smart contracts, and so they're kind of trusting Compound to do a good job with their audits and reviews. But also the way that people are getting these yields are also becoming more and more complex. People are trying to farm extra yields by basically borrowing funds using their collateral, and then redepositing those funds into a different wallet, and then borrowing against those again and over. Some apps allow you to do that 4 times, where you're kind of folding your deposit back, but theoretically you can do it even more than 4 times. The problem with this is that it increases the leverage in the system. So it's kind of an indirect, incentive that people are trying to capture by doing this. But it increases the smart contract risk as well, because there's going to be a lot more value that's locked into these contracts. If you look at traditional finance, there's very few companies that within, a month of launch, they can get so much money deposited into their systems, 700 million within a month. The other risk is that it increases the risk of liquidation. So depending on what asset you're borrowing and supplying, if the value of your collateral falls significantly, or the value of what you're borrowing goes up significantly, you can get liquidated, and there's a fee that's associated with getting your position liquidated. And that fee could be potentially a lot higher than what you're earning interest rates in the first place. So those are kind of the risks. Regardless of the opportunities and risks, it's a very new ecosystem. This has not really been around for a very long time, but it has a lot of promise. It can tackle some long-standing problems that I think many of us who got into blockchain wanted to try to tackle. And it personally is the reason why I was really interested in blockchain. The main problem is that like the traditional financial system is very inefficient, right? So, you know, if you want to go to a bank and do a bank transfer, that's pretty inefficient. There's kind of not a lot of liquidity for borrowing. If you wanted to even get a loan, most of the time that's a very complicated process. Even if you had the collateral and could prove that you know, you had these assets, you have to go through a long process to get a loan. With DeFi, you know, it's very fast. It's all handled by smart contracts, so that reduces a lot of the costs and friction that's kind of captured in the traditional financial system. And what I've seen with the new DeFi applications that we're auditing is that now there's many different sectors that these applications are tackling as well. So I think over time that the composable nature of these applications is going to be really strong, because the security of these applications will get improved out over time. The user sophistication will also improve over time, but also the applications will become more specific. So that's another benefit. So now I'm going to talk about some applications that we're excited about. At QuantStamp, we've been auditing dozens and dozens of new DeFi applications, including many different DAOs. You know, one DAO that we've worked with pretty closely is called Metacartel DAO. We've also audited almost a dozen projects for the Maker DAO, grants ecosystem. So let me just talk about some of them. So 4 of them I'm going to talk about. One is called Idle. The second one is Nuo, and then Pull Together and Zero Collateral. So Idle, what they're doing is very much based on this kind of composability money Legos theme. So right now, one of the problems for users of DeFi is that there are a lot of different services where you can get yields you know, on your deposits. And what Idle does is similar to like a wealth front, where they're automatically rebalancing your portfolio and trying to get you the maximum yields for your specific risk parameters. So you don't have to constantly go around and hunt for the best yield. They will automate this process by rebalancing. And I think that's pretty cool, because it's kind of another layer on top of these protocols like Compound that can do a meta balancing of all this optimization of the yields. The second project I'm going to talk about is Nuo. So Nuo, they're a project based out of India that offers global borrowing and lending and margin trading. One of their really cool features is that they are actually coming up with a Nuo bank called Juno, which is kind of a bridge between traditional finance and DeFi, and allows people to open a bank account and get access to the great interest rates in DeFi. Yeah, and you know, it's been around for a while, and we're pretty happy to have audited it. The third project I'm going to talk about is Pull Together. So Pull Together is interesting in that it's a very blockchain native creation. It's a brand new idea. So what they're doing is offering a no-loss lottery where if you participate weekly, there's no chance that anyone who participates can lose their funds. And the reason is that they basically pull everyone's funds together and then deposit that into Compound Finance. Every week, they then select a provably random winner, and the winner of that week gets the interest from the whole pool. So everyone else doesn't lose their deposits that they purchased the lottery ticket with. And the other benefit is of a no-loss lottery is that because you never lose your deposit, you never have to spend money for the lottery tickets. they allow you to roll over the lottery tickets from week to week. So, you know, a lot of people buy lottery tickets, and it's usually because there's some kind of psychological reasons why people like to buy lottery tickets to try to win a really big jackpot. And what I like about Cointelegraph is that they're kind of using this same psychological trick to make something really approachable for people, part of people's daily habits, and adding a better savings element to that. Because if you buy regular lottery tickets and you don't win, then you're kind of spending your money. But here it's encouraging people to save more. And they're also using composability because they're funneling the interest rate payments, but also using compound to get the interest as well. The last one I'm going to talk about is zero collateral. So right now, one of the problems in decentralized lending is that whenever I want to get a loan, I always need to supply collateral that is higher than the amount on my loan. So let's say I want to get like, you know, $100 of USDC loan, I have to maybe supply $200 worth of Ether. And as you can imagine, normally when I go to a bank, like a regular bank to get a loan, usually the whole point of getting a loan is that I don't have the collateral, right? So if I want to, you know, buy a house or get an auto loan, I don't have the cash to be able to supply as collateral, only to take out a fraction of that. So I think they're trying to improve the experience by offering this kind of under collateralized loan. And their initial approach is that when you get your first loan, they will start to track how much interest you paid into the system. And over time, they will, if you get another loan, they will deduct the amount of interest that you paid in. And it's possible eventually to get to a point where you actually don't need any collateral by having continuous, like, kind of a blockchain-based credit score to reduce the amount of your collateral that you use. So I think it's a very interesting idea that's still pretty new, and hopefully over time we're going to see more of this. Onto the security issues. So, you know, in 2020 alone, there's been about $26 million that's been lost due to hacks in DeFi. You know, on the right, this is pretty recent news where a liquidity pool and balancer was drained due to a deflationary token. Many of the DeFi projects, there's been vulnerabilities that have been found, and in some cases stolen. So one of the largest attack vectors in DeFi is through these under collateralized loans. And the way the attacker does this is they manipulate the price of some assets on the blockchain temporarily, and then they deposit those assets that are temporarily inflated into one of these lending protocols. And then they borrow another asset, a different asset, using this artificially inflated price. And after they borrowed it, the blockchain is immutable. So there's no way that the protocol can get the money back. And in effect, they got free money from inflating some artificial on-chain price. So I'm going to show some examples of this. So first, there's this Statera example, which happened very recently from Balancer. And what they did was, normally in the ERC20 token, when you transfer it, the amount of the token at the start and after the transfer stays the same. This is called the invariant. But the Statera token, it didn't respect this invariant because it's built as a deflationary token. So every time you transfer it, 1% is destroyed. And this can be very confusing for protocols because they're not built to handle this type of token. So what the attacker did was they found a pool that had this deflationary token, and some other ones like Ether and Wrapped Bitcoin and Chainlink and some synthetics. And they repeatedly, swapped the token back and forth with Wrapped ETH until there was a very small amount of Statera token left in the pool. And because of the logic in the pool, they were able to use this very small amount of token to swap for all the rest of the assets like Ether and Bitcoin in the pool. And after they've drained all these other assets, they can basically walk away with the money. So, this happened to 2 different pools, and about $500,000 was stolen. Another hack that happened before this one was called DeForce. And in that one, about $25 million was stolen. This actually leveraged a reentrancy attack. So it was somewhat of a known issue. So the attacker was basically able to borrow a lot of other assets on the DeForce's platform and exit with all those assets. And obviously, the blockchain is immutable. So, but fortunately, what happened was that I think the team and some members of the community were actually able to track down the hacker. And at the end, they returned the funds to DeForce. So, that's another type of vulnerability that's out there. The third one that I'm going to talk about is the BZX hacks. So there were actually 2 of them, and they worked in slightly different ways, but they had the same outcome. Basically, the attacker was able to, open a large undercollateralized debt position, leave with the debt, and have the temporarily changed price revert back to normal. So in the first one, what the hacker did was that they artificially inflated the price of wrapped Bitcoin on Uniswap, and this is Uniswap V1, and now Uniswap, there's Uniswap V2. So now the attack is not possible anymore, but they basically took this overpriced wrapped Bitcoin and got a lot of ETH from it, and then just basically walk away the ETH and then have the Bitcoin price return to normal. The second one that they did was using Kyber. So they actually artificially inflated the price of SUSD versus Ether, and then they deposited this overinflated SUSD as a collateral, took out a big loan, and then after they took out the loan, they just don't have to repay the funds. So that was the second attack. And this happened during December, so still fairly recent. The reason is, for showing these examples is that we think security is very crucial for DeFi's growth. Imagine if you were part of these pools or using these products, and one day you find out that whatever funds you had to put in to lend are now gone. It might not be possible to have the team refund you because the project is supposed to be decentralized, and there's no way in many cases to track down the attacker, and so your funds are gone forever. So what this means is that it's much more crucial in this case to have proper security ahead of time, and for the users to be educated when they decide which products to use and how to protect themselves, not to over leverage or to take too many financial risks, and to understand exactly what type of risks they're taking. We think that on top of just doing security audits, that getting security monitoring, live monitoring, encouraging increased transparency from the projects, and also getting insurance in the future is going to help to increase DeFi's potential. And also many of these projects are going to be battle tested over time. And as they get battle tested over time, the risk will start to decrease, if they don't keep adding more features. We're pretty much heavy believers in DeFi, and I think there's a couple of reasons. One is that the world is increasingly global, and so as kind of one of the first internet native generations, we're used to dealing with each other on the internet, making transactions, doing e-commerce, and there's no logical reason why traditional finance is so landlocked, often landlocked to local jurisdictions. The second reason is that it can make markets more transparent and permissionless. It can give people a lot more access to different services and create financial opportunity for people. And I think that many of you in the audience could even be building this next generation of really awesome financial products, and I look forward to seeing what you all build. For Quantstamp's role, we think that our role is to help to secure the decentralized web. There's so much risk out there whenever projects release new products. People kind of jump onto it without fully understanding. And so we're trying to safeguard many of these new projects who are building really cool stuff and making sure that we can continue to have more users join the whole ecosystem and feel secure doing that. And we think that DeFi, it provides a lot of value to society. And this trend grows because of the money Legos. So as people build interesting building blocks, those are kind of permanent, and new people can take advantage of those over time. So we're very much in kind of this building the foundations phase. As part of building the foundations, Quantstamp also recently audited one of the leading Ethereum 2.0 clients for Prismatic Labs. This client is very similar to the Geth client that people use for ETH1. And we think that this is going to have a lot of impacts on DeFi. We recently completed the audit, and the progress is going really well for the Prismatic team. They've done an amazing job in terms of releasing it and having it be so well tested and so well built. Some of the impacts is that once these stages of ETH 2.0 launches, we can see much lower fees for DeFi. One of the big problems right now is that the fees are so high on these networks because a lot more people are using Ethereum now. They're using it for the stablecoin transactions, for many of the DeFi products. And having lower fees can also decrease the barrier for game companies. Because when you're making large financial transactions on DeFi, you might not care about the high gas fees. But if you're running a game, that becomes a lot more important. With the transition to proof of stake, it also means that the blockchain can process a lot more transactions in terms of throughput. So what that means is we can handle more people who are using this, because right now one of the big bottlenecks is not just in terms of fees, but also how many transactions you can just handle. And in the near term, I think some of this is going to continue to move to layer 2. And there's been many cool companies that's building products for layer 2 that we think are going to start taking off. Lastly, we think that there's going to be some impacts on composability, which is kind of linking all the products together due to sharding, and researchers are still finalizing that, but that's going to continue over time. But maybe we can get a lot of the benefits from having these kind of like the initial ETH 2.0 plus some layer 2 solutions. And yeah, in terms of what's next, we think that there's going to be a lot of great opportunity for growth and development in DeFi. It's definitely going to continue, and that we're still in the early days. And we look forward to seeing what some of you in the audience build, because we're very strong believers ourselves, and we want to see this wave continue. And that's it. If you want to learn more about the recent hacks and dive into it more, you can go to quantstamp.com/blog, where we try to break down the hacks, or go to our QR code. And thanks everyone for attending my talk. Appreciate it.